Welcome into Chit Chat Stocks. This is our weekly Power Hour episode. I am one of your hosts, Ryan Henderson, and I am joined, as always, by Brett Schaefer. I was MIA for the last 2 weeks as I was on vacation, so you were joined by Dave from the Investing for Beginners podcast. But Brett and I are both back in the quote-unquote studio today, and we've got tons of topics to revisit. I guess before we get into things, Brett, how are you? What did I miss in the financial world?
Ooh, I don't know. Pepsi, tough report. I guess no one's talking about that one, but I think that's quite interesting for the CPG food space. Hindenburg had a report on Roblox, and then there was some short seller on short seller attacks, I guess, against each other, although we're not really going to talk about that today. And besides that, I think you picked a perfect time right before earnings season. And now we're finally getting some companies updating their reports. We're going to get more than speculation on things. I think we have a good show to go through today.
All right. And as always, before we get to that, we want to talk about our friends at Public. Heads up, folks, interest rates are falling, but you can still lock in a 6% yield or higher with a bond account at public.com. That's a pretty big deal because when rates drop, so can the interest you earn on your investment. A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. So while other people are watching their returns shrink, you can sit back with regular interest payments, but you might want to act fast because your yield is not locked in until you invest. The good news, it only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account only at public.com/chit chat stocks.
Hey, guess what?
Where do
I did open a bond account and I deposited some money. I liked it. It's like the in between of a
easy
savings
process?
account. What?
Easy process?
Yeah, fairly easy process. Almost like they make it sort of like a savings account, but I should say as a fair warning, it's not exactly a, risk-free rate in a savings account. It's kind of in between the savings account and say a full stock portfolio. I think it's something that's nice in the middle if you're trying to, spread out your yield or spread out your return profiles. If you're trying to save for a down payment on a house, stuff like that. And I found it fairly intuitive. So. But maybe we need to have you as our resident tech Luddite at some points test it out, because I think that's maybe a better test.
Yeah, probably. But anyways, yes, that's our friends over at Public. We have a jam-packed show today. You have a ton of topics. I have a ton of topics. And a little foreshadowing here. This small cap of the week is my favorite by far that I've ever done. So, yeah, it's you're on mute there, but I saw you mouth the word wow. It's pretty interesting. I think you'll be intrigued.
Okay, that's exciting. Nice little tease for the listeners. We'll get that about maybe halfway through the episode. Do you want to talk? And I know we have to talk about this just because people listen to this type of stuff. The RoboTaxi event. We Robot. Did you check out this at all?
Sure. So I have gotten to the point now with anything Tesla related where I just kind of don't pay attention because it just feels like there's so much going on a regular basis with them. So no, to be honest, I saw a couple videos, but it's so. Whenever I see people like, oh my gosh, you're not going to believe this technology, it's like The Boy Who Cried Wolf with obviously the solar panel stuff that was actually faked. That's been proven. And there was a little bit of fake it till you make it technology here with this one as well. So it just kind of, I don't know. I'm not blown away ever by these events. Like they're cool, but it just never feels concrete.
Yeah, it is interesting. Like on the one hand, yeah, at the same week, SpaceX has a very cool and seemed to be, I know some people call it impossible, but it was more of just a very difficult engineering challenge. Not to downplay it at all, but it was something that you could theoretically do without inventing some new technology. They landed that 20-story rocket in kind of that thing that almost like a reusable thing. It's kind of hard to describe. You can watch the video. That was very cool. Business model on that.
Was that the Falcon Heavy?
No, it was the new one called Starship. So they actually went way bigger and they reused it as a test flight. pretty interesting stuff on that regard. But I would ignore all that if you're looking at Tesla, because it seemed to me like this could have been in 2019, 2020, 2021, 2022. It was an event that said, hey, look, we got this full self-driving stuff coming. It's coming in a few years. Don't you worry. And we're going to have all these robotaxis. And I'm with you now. Wait until, I see it actually materialize, because there's been all these arguments that, oh, wait, just the next upgrade. Don't worry, the next upgrade. And it's interesting that Waymo seems to be making real progress. Now, there's some, people do some analysis on their costs, where having all that tech added to the car makes it extremely expensive. So the unit economics might not be that great, but they are actually making progress on the technological side, where Tesla doesn't seem to be doing much. It's a lot of, hey, wait until we see what happens. But what do you think about this, Ryan? The last topic here, the Optimus bot. Are you taking the over or under on the $25 trillion in market value that it'll generate, according to our good friend, Elon?
Is that what he said?
That's what he said. Kind of he tosses numbers out from time to time.
It's like that scene in Succession where he's like, what's the largest number that's feasible that I can say?
Yeah, exactly. Well, and then he ignores it, but...
Yeah. So this was pretty clearly, at least from my perspective, this was pretty clearly not AI powered. It was somebody controlling it remotely. The robot was a robot, but it was being remotely controlled by an actual person for speech and movement purposes. And at first, everyone was like, "This is insane. He can pour me a drink or whatever." And then it kind of came out that, okay, this is not real. Someone's controlling it, and they're like, okay, so this was mostly a person, but there was still some AI elements. I'm like, it's just it's a charade. It's not. It isn't real. It's cool, whatever. It's a cool little presentation, but it isn't. There's nothing of value there, for shareholders.
Yeah, what I would be concerned about is the fact that they're not investing in new models, and that the Cybertruck is a really niche product, so not going to drive much in earnings, and then they're going to pour all their new R&D into AI, the humanoid robots, and these, what do they call it, the RoboTaxi? No, the Cybercab. Now, I gotta say that's probably a better name, but if it's all betting on that over the next few years, and you don't have these new car models, like what happens if these things don't materialize? That would concern me a lot, because the existing models are getting quite old, and we'll see what happens on their earnings. We'll probably talk about them at least for a bit. But anything else on there? Because we got a lot of other topics that I think are fun today.
No, it just, to be honest, it just bores me. The SpaceX stuff, really cool, but the Tesla stuff, it just bores me. Because, and I think the thing that bores me the most is that it comes at a time when Waymo is doing some real stuff. Like, they're expanding city by city. There's a commercial growth there. Like, they're generating revenue. And people just seem to be ignoring it at the hope that RoboTaxi or full self-driving ends up materializing at some point. Doesn't seem like that's going to be the case, but we do have some other stuff we want to talk about. Where do we want to go next? We've got kind of endless topics here. China's back. You want to talk about that?
Yeah. Well, it might be collapsing again. I guess actually I should look at what the KWEB index is doing today, because I think it may have been because of a interview on CNBC from David Tepper, who, I don't know what his motives for doing that were, but he seemed to get the firepower going. If you look at, and maybe I'll share a screen, but if not, it's not too hard. The stock market, and we can use the Crane Shares China Internet ETF, KWEB, is kind of a proxy here. It was down to about 25, and then it shot up to close to 40 within a few weeks, and maybe even less, maybe like 2 weeks. So there was a huge jump, and I think it was kind of all on the sentiment about a government change in narrative, and that is so dangerous in China, because you're going, the lost in translation risk is absolutely huge. But what I think is interesting is if you zoom out over the past 5 years, the stocks the KWEB China Internet ETF is down 26% cumulatively, and it used to hit an all-time high of 100, and now it's still down at 32. So I don't know if this rally makes much sense, and it doesn't change anything for me. I've always said, and we've talked about this plenty of times, this index, or just use this as a proxy again, it could be any index in China or any stock. It could be trading at 5, 50, or 500. That doesn't change much when you're worried about like business law actually being like existing in a country.
Yeah, for me, it's we've called China uninvestable because of the business law concerns and the government and sort of capital markets philosophy from leaders over there. And so it's on the one hand, it's like, what would I need to see to invest in China? I would need to see a change in the approach from political leaders around capital markets. But
Literally
on
a
the flip
change in
side,
the whole country's economic model.
I'm not buying on any of this. Like every time I hear there's like more positive sentiment from leaders over there or there's any sort of change, I'm like, I don't believe it. So I don't know what's going to ever make it investable. I think if I just started seeing Chinese companies with ADRs paying out dividends on a regular basis, that might do it because then you at least have some level of a hedge. But
Somewhat, yeah. I mean, Alibaba pays a dividend. It's like 2%. I don't know if it's not large enough. I would like to see a higher yield just to make up for that risk. But what I thought was interesting and what I compare it to, because to me it's again like without the laws, it's just things on paper. There was a very funny post. I don't know what you're supposed to call it now, from OpenSea. Do you remember OpenSea, Ryan? No,
no.
the NFT trading marketplace.
Oh, yeah. Kind of.
Yeah, it's old. Hey, on October 15th, which is yesterday, as we're recording this, they had a tweet that basically was pretending it was someone saying something. So there's quote, NFTs are dead. And then they said, please zoom out. And then this one guy, I'll share the screen here, zoomed out with some data. And let me load this up. As you can see, well, if you zoom out, I guess the chart goes from 2018 to 2024. I guess if you go back to 2018 when they didn't exist, there's been infinite growth, But if you look at OpenSea volume, I think it's probably 4 billion transactions. So that's when it peaked. It looks like maybe on a quarter. No, probably a monthly. And now I would guesstimate that it's probably at 50 million. Given that this chart is just too small to even really. It could be 100 million. But this type of stuff, I don't even know how to think about it because it's like the business is dead. And then this Twitter account is out there doing this. Is the CEO the only one there left just tweeting this stuff? Is he kind of going full crazy? I'm not sure what to even think about it.
Do you remember when? So here's the thing that blows my mind about the NFT craze. Smart people that I respect, bought into it. Maybe they didn't buy NFTs or whatever, but they were like, no, it really is revolutionary technology. But there was like the screenshot stuff. Are you
Oh,
kidding
so
me?
good.
Like you could just screenshot it and it's like, it's not proprietary. Yeah, whatever. You might have your own. It belongs to you. But if it's on the open internet, it belongs to everyone, frankly. So yeah, not really sure what's going on there. Nice to
Well,
see that that's kind of rolled over.
Yeah. I mean, I just thought it was funny. I thought it was funny, and comparing it to China, I think because the Chinese stocks, and again, we sound like broken drums or broken records. That's how we see them. Is there's no when you don't have rights as shareholders, that's how we look at them, as almost like an NFT where, okay, I don't have confidence that what I'm getting is what you're saying. And with the actual idea around those NFTs, yeah, it did make sense. So like, how do we enforce these royalties? Like, well, maybe they have a good system in place already where you have the government, with a giant military and the police force that can enforce these things in a judicial system. You got to build all that to make it legit. Now, maybe we already got that. But Here's something that relates to
It
China, Ryan,
Yeah, go
and it
ahead.
might be a way to invest in it. The luxury companies. Did you check out LVMH's report? And if not, I do have a question from Twitter on them.
So it's not like the official report, right? It's just like a sales update thing that they post before the official report, or maybe that's how they do quarterly periods.
Yeah, because
But
European. Yeah,
yeah, I looked at it briefly. Apparently, sales of cognac are way down in China, so I
I
guess
think
people are
the
no
government
longer
kind of.
celebrating.
Yep. Well, I think they're proposing a tariff on them, so maybe that could lead to a short-term increase. But the government seems to have given an old ladder attack on them because the European, I think it's the EU, is putting on tariffs on electric vehicles, and this was a way to retaliate. But here's the question we got, and actually it wasn't from Twitter. It was from a post on YouTube. So if you don't like Twitter, but you want to follow us on YouTube and ask us questions, you can do that as well. I think I'm going to try to post that once a week. Here it is. LVMH starting to look cheap. Nice luxury brand conglomerate, including Sephora and many others. I didn't know they own so many well-known luxury brands. Pretty stable stock up and to the right. My biggest concern is China, 38% of their total revenue. The CEO has a very good track record of creating value through acquisitions, and the family still owns 48%. Are you interested in them at all? I think the free cash flow yield is about 5%. Let me kind of pull up a number for you, but hey, maybe maybe the consumer depression in China is priced in for them.
Yeah, it could be. I think he summarized it pretty well, actually. The biggest concern is probably China. There's the chance that continues to decline. It's not. Maybe there's a chance that it's like a temporary blip and things recover over there, but I would say it feels like there's equal risk both ways in China. The rest of it, yeah, Bernard Arnault has been an exceptional capital allocator, and the only other big concern for me would be succession planning. It sounds like they have like a literal. If you've seen the show Succession, it sounds like that's basically what's going on over there, where they're kind of competing to see who's going to run the company among the kids after that. But I think the existing businesses will be fine. So I don't know if it needs to be like some phenomenal acquirer from here to generate solid returns, especially at a 5% free cash flow yield or whatever it is. So yeah, I'm fairly interested, but for some reason, and I don't know what it is, and sometimes this happens to me, and I have no idea why. I have zero interest in LVMH. I don't know why. Maybe it's too big,
Yeah.
but there's certain companies for me where I just kind of shrug my shoulders and think it's just not for me. Maybe it's kind of narrow thinking, but that's kind of what I think with LVMH.
Yeah, and I'm sharing this chart from FinChat, our good friends over there. PE, according to them, about 21 and a half. So not a crazy valuation if you believe they have that pricing power to keep growing. But yeah, I agree with you. It's large. I think the risk of losing money over the long term is quite low with this company.
Yeah, I
Maybe if I
agree.
was 50, I would be all over this. But who knows? I think it probably works from here.
Yeah, I would agree. Someone in the comments, Tyler says, last I saw, Bernard was buying in the open market as well. I tell you what, you get a CEO who's nearing retirement that's buying in the open market, that's probably a pretty good sign. But I mean, maybe it's going into some inheritance for the kids or whatever, so it doesn't really matter. But yeah, it probably works out, but I just don't think I'm going to be along for the ride for some reason. I just kind of
Yeah.
shrug my shoulders.
Well, the China exposure can be like it's not as bad as say the Chinese listed stock because it's they have a great relationship with that market and it's such a big region for them, 38% of revenue. But I have no read into the Chinese economy. Like, are we going into a great leap forward for them where that's just, this total stuff that you kind of read about that where things could get really bad really quickly? I have no clue. And that could crush LVMH's business. But yeah, I agree. 20 times earnings on trough earnings, like where they have pricing power, where they have proven pricing power, and they're going to have more demand the richer the world gets. Hey, look, yeah, it'll probably work. I could see this being a very safe stock if you like low risk things over the long term.
Yeah. All right. I want to do 7 companies that are 100 baggers that people probably haven't heard of. Or maybe they've heard
Okay.
of them, but they did not know they were 100 baggers. So I'm going to go through this.
Okay. We have
I'm
one.
curious.
Or go ahead.
All right, go ahead. Go ahead.
We have one question in the comments that says, "Do you guys have any thoughts on Crocs, ticker CROX?" I would say we did a show on them, which you can look in our feed from a while back. I'm sure that still plays today. I haven't kept updated on them, but I was too worried about how you're determined by people that are 25 and their what they want to spend money and where, because that seems to change every year. So no, not too interested.
Yeah, with Crocs, I will say Crocs has been far more of a lasting business than I expected. Like, I would have thought, especially like 10 years ago, you would have thought there's no way this lasts. And the fact that more and more people are buying Croc shoes and people buy them actually on kind of a recurring basis, it surprised me. So I could certainly see it working to the upside. I'm probably more positive on them than I am negative, but yeah, same with you. I kind of have a retail's not acceptable or no retail for me approach.
Yeah, or apparel.
Yeah,
apparel. Yeah, some guys say Crocs has too many holes in it. That's a good one. Too many holes in that thesis. All right, that's a good joke. Hope a couple listeners chuckled there.
Yeah, let's go through 7 hidden 100 baggers. So number 1 here, and I'm doing this in order of total return, and this is just over the last 20 years. So some of these actually, if you bought them 30 years ago, might not have been 100 baggers. That, maybe they had a drop or whatever, but I'm just doing it on 20-year total return. Number 1, Universal Insurance Holdings. This stock is up 141,000%, which is outrageous.
1,000
And
bagger.
I think it might have had some like a bankruptcy or something that happened 20 years ago, and it was a penny stock, and it kind of like came out of bankruptcy and did all right. Well, did better than all right. Because the overall returns, if you go like max back to the IPO, whatever it is, were like bleh, they were fine. But yeah, for some reason, if you bought this 20 years ago, you had outrageous returns. Number 2, and just for context, that is a residential insurer that operates primarily in Florida. Number 2 is Wisdom Tree. I did not realize Wisdom Tree was such a impressive investment. They're an ETF sponsor, asset manager. You've probably seen their commercials or something on TV, as all ETFs and asset managers seem to run endless TV commercials. Up 61,000%, so 610 bagger. EV to EBIT 14 times. I don't know. Is there maybe the story's not over there? So we'll see. Did you know that they were such a good investment?
I had no clue. I had no clue they were public. I only briefly knew, just probably because of seeing a couple commercials, that they were even a company. Like, I've heard of the name, but I couldn't tell you what exactly the financial products they sold.
Yeah, it's kind of news to me as well. Okay, third one here is Vitec Software. This is a Swedish serial acquirer of software companies, and it's performed really well. It's like a $2 billion market cap, 362 bagger. A lot of these have kind of gotten marked up. Yeah, Brett's showing the chart here. The recurring revenue is up, what is that, 100-fold? No, 10-fold over the last 10 years.
23.5% CAGR on that recurring revenue. That is, I should say, a little KPI chart from FinChat. So go check them out. This is the type of stuff you can't get anywhere else. Use our code finchat.io/chitchat. But yeah, this is basically a Constellation Software copycat, correct?
Yeah, pretty much. That's basically what it is. And it trades at 35 times EBIT. So the cat's kind of out of the bag, I think, on this a bit. But, some of these roll-ups can look like they trade at higher multiples and still perform pretty well, depending on how they finance acquisitions and stuff like that. So number 4, though, and I know you're going to hate this one, LVMUY. Have you heard of this company?
Perhaps, but I have no idea how to say it. Hopefully,
Yeah, I might be saying it
apologies to
wrong.
any Chinese listeners for us butchering any spelling or pronunciation here. But I know that this is the biggest market for liquor, wine, and beer worldwide. So I'm sure
Yeah,
they dominate.
I'd seen like pictures of the alcohol they produce. I think it's like mostly native to China. But they sell wine and liquor products primarily in China, and which is kind of ironic because we just talked about how LVMH is seeing cognac sales drop in a big way in China, but they have done really well over the last 20 years. It's more than a 200 bagger, and they just announced a huge buyback, which seems abnormal for Chinese companies in general. But yeah, it's probably one of the biggest Chinese companies overall, market cap wise, and seems to be one that a lot of people just never talk about. But anyways,
Yeah, the thesis could make sense where if foreign brands are kicked out, hey, they'll probably turn to their products.
yeah, absolutely. All right, I'm just gonna go through these last three kind of quickly. CD Projekt. It's a Polish video game developer. They're behind games like The Witcher and Cyberpunk 2077. CD Projekt had like a horrible IPO, so it makes the returns look a little better, but it's been a very lumpy business. Number 6 is Decker's Outdoor, which you hear that name, and to be honest, I think it's like some sort of a decking product, like Trex or something,
Tracks,
like
yeah.
maybe composite wood. But no, they sell Hokas. They are one of the biggest footwear companies worldwide. They have a bunch of brands. They still sell their parent company behind UGG, which is kind of starting to become a little more popular again, surprisingly, but it used to be very, very popular. And then Hoka's it's kind of revitalized that business. Last one I'll talk about here, Monolithic Power Systems, another 100 bagger. These are all 100 baggers. Designs and sells semiconductors based power electronic solutions. We talked about this with the chip stock investor team, and they said that was the number one semiconductor stock they did not expect to do well, that has performed exceptionally well throughout this basically sort of AI boom.
All right, good companies. What are
Now,
your top two? What two feel not on valuation today, but any of them investable at the right price to you?
it's kind of funny because they've all performed so well, but I find all these pretty uninteresting.
What about Vitech or Wisdom Tree at the right price? I think those are ones we could understand.
Yeah, Wisdom Tree maybe, but I think it's maybe more just like more commoditized today than when they first started issuing ETFs. Um, with Vitech, like I said, the cat's out of the bag, trades at almost 40 times EBIT. They've had like a business breakdowns episode. It's fairly, I think they have, maybe I'm wrong on that, but the one thing I have been surprised by is these VMS, vertical market software acquirers, have way more acquisition targets than I thought.
Yeah.
And they're able to do it in big bulk. Like Constellation, I would have thought was running out of targets like 5 years ago. And maybe it's just because vertical market software is still growing. But so the upside seems to be there, and I would say those two companies have certainly surprised to the upside
What
relative to
about a
what I would have
residential
thought.
what about a residential insurer that operates primarily in Florida? That sounds like a high risk, high reward opportunity.
Yeah, maybe they're one of the only ones left. I don't really know how they've done so well. I'm curious if they've sold off. I'm curious how much their stock price is tied to like natural disasters. Like when you hear rumors of a new hurricane or something, how much does the stock take a hit? I imagine it has to be pretty tied to it. So, yeah, I'm pretty uninterested in most of these, to be honest.
Yeah, well, that can happen where people are uninterested because it's hard to say get a good thesis going, but then the company executes so well, or perhaps gets lucky and boom, you go from 5 times earnings to 30 times earnings, and you're considered a can't miss investment.
Did you see this? This is my. Remember how we used to do hero and zero of the week? This this might be my hero of the week, to be honest. But did you see this post on LinkedIn?
I did. Yeah.
What did you think?
Interesting.
Do you admire
No.
the spirit of the guy?
No. I don't admire any
into 7
posts
years
on
of
LinkedIn.
prison.
No, I delete your LinkedIn, everyone. It's stupid. But
The comment was taken down, or the page was taken down. But
good. Well, everyone at FTX is. If you said you worked at FTS, my base case is you're crazy. And
yeah,
this
probably
is helping prove my point.
And so, just for context, for anyone who didn't see this, last week, Ryan Salame, I believe is his name. He's the former co-CEO of FTX, the now defunct crypto exchange, fraudulent crypto exchange, was charged with basically, I think it was money laundering, a bunch of different financial charges, and given 7 years in prison. And he posted a starting a new position LinkedIn post that says, "I'm happy to share that I'm starting a new position as an inmate at FCI Cumberland." Perhaps the funniest part about this was you saw how many automated responses there were, because there was a whole bunch of people in the comments that said, "Congrats on the new position, Ryan. Very exciting."
Good.
Or something.
LinkedIn sounds so valuable. I can't believe what I'm missing deleting my account.
Yeah. Anyways, okay. Where do we want to go from here?
I was thinking ASML earnings, but let me hit some comments here. We got Andrew Marshall from Capital Mindset, or no, Mindset Capital. I always mix it up. But Capital Mindset is the YouTube channel, and they've done shows with us before. It's Capital Mindset. We should have them back on for sure. And he says,
Andrew, if you're listening.
Yeah, I have a good residential insurer in Florida. If you're talking ACIC, I can give you an in-depth pitch. Hey, maybe we do that. That sounds fun. I'd love to get those guys back on, or at least one of them. Let's see. Other questions from someone. How to approach Boeing, and then the thinking emoji. Don't. Stay far away. Back away. Do not back away from the keyboard.
Do not approach them.
Yeah, they're raising money. And I might have to raise tens of billions of dollars because their balance sheet is running out of cash.
Yeah, I saw a quote this week. The CEO said they could raise $25 billion if they wanted to right now.
I would do that.
Well, I'm sure you can. At what interest? I'm curious. Probably not a very attractive rate. Who is offering this debt to them?
Well, it depends what the price is. Maybe it's convertible.
Still, it makes no sense to me. Good for them. Our theory was that if they were ever bailed out, it would look like it wasn't a bailout, and maybe that's the case. Maybe that's where they're raising the money from. It's like subsidized by the government in some way. But
yeah, that could make sense. Or raising an equity offering at a really cheap price. There's ways to do it.
Yeah, when you say how to approach Boeing, if they're doing an equity raise at really cheap prices, that's not good for existing shareholders.
You got to get to the other side before considering investing here. Let's see. This one relates to the topic I wanted to do next. So Tyler says, thoughts on TSMC given Intel's collapse and Samsung's semiconductor head's public apology. I didn't see the public apology, but Intel has collapsed and TSMC, well, I mean, look, TSMC continues to roll. And I know they're struggling in some things, but yeah, I don't know. It seems like with TSMC, before we move on to ASML, keeps expanding their lead and keeps locking in the important customers. Ryan, I know you're an expert on them, but
I have nothing to add, I think, is the Charlie Munger approach here with, I would just say with pretty much anything semiconductors, I'm going to go ahead and say I have absolutely nothing of value to add. TSMC seems to be the leader. Intel seems to be struggling, and I don't see why that would change.
Yeah.
Is
Yeah.
that fair?
Sure. Yeah. Intel.
Like, how hard is it to catch up? It's got to be pretty difficult. You
Yeah, I
can't
don't
just
know
throw
if you.
money at it, right?
Yeah, but there's more than just the most advanced nodes. So Intel will probably end up like they're going to exist. I don't know if the stock's going to do well at all, but they're going to exist because there's so much investing and tax receipts that are going to come through. But yeah, let's talk ASML earnings. They released it prematurely by accident. Maybe they did it on purpose by accident, quote unquote, because they were pretty bad. But who knows? Probably just a fat finger. Here's a quote from the report, and I think this is what led the stock to fall at 20%, I believe. Quote, while there continue to be strong developments and upside potential in AI, other market segments are taking longer to recover. It now appears the recovery is more gradual than previously expected. This is expected to continue in 2025, which is leading to customer cautiousness. I'm going to share a chart here, and it is their net order bookings for essentially just not the revenue earned, but how many orders were placed and the dollar value for that in the quarter. And it was down to 2.6 billion euros, way below the semiconductor boom from like the end of 2020 to the end of 2022. I would have thought I really would have thought this would be soaring if AI, because I get what he said in the press release that AI demand is there, but I thought if it was such a big super cycle, it would make up for everything else lost, given where these stocks are trading, given the multiples, given the growth projections, all that. Now, if we zoom out the last 12 months, the net orders are significantly higher than pre-pandemic. So it's not the end of the world, but it is one bad quarter. And I was kind of shocked to see it, given that we're still seems like there's no sign of semiconductor spending slowdown for these AI data centers.
Yeah, what a lumpy business. Like,
Yeah.
like your bookings could be down 75% year over year, just depending on the timing of like probably 2 or 3 orders when you're selling, what is it, $100 million machines, multiple $100 million machines. So if you are someone that follows ASML really closely, I imagine there are a lot of, and maybe this is one, a lot of buying opportunities that come in because people just can't handle the headline numbers and can't handle what look like big booking drawdowns, even though it's just a very lumpy business because they are huge orders in terms of like one order can kind of make or break a quarter.
Yeah. And it could be a buying opportunity. I think it's definitely, if the business hasn't changed that much, it's way more attractive right now. We have a comment here from Tyler. It seems to be a little more in tune with the industry. It says Intel and Samsung seem like they're delaying their fabs, which mean manufacturing facilities, due to their own internal issues. So they won't buy as many EUV and eventually high NA until 2026. Those are ASML machines. Their orders will come randomly in 2025. I'd say maybe. Like, we don't know. But like it might. But what I'm saying, what's interesting to me is, okay, the idea is that AI as a whole, like take the whole semiconductor market, it's going to lead to demand growth, right? And there needs to be an increase in supply. And it doesn't matter if TSMC is taking a bunch of share from Intel and Samsung, that the sum of the entire industry should be rising of the spend. And I don't understand why bookings are down, because I get that Intel is struggling, but why isn't it showing up somewhere else is kind of what I would be concerned about.
Yeah, that's a good question.
And there was
before we move on,
go ahead.
Hold on. Before we move on, we do want to talk about our friends again at Public. Heads up, folks. Interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds only at public.com. You might want to act fast because your yield is not locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/Chit Chat Stocks. Anything else to add on ASML? Because I want to talk about my small cap of the week. I've been dying to talk about this.
All right, yeah, we'll get into that. Last thing, they said that they're seeing a big slowdown in demand for computers, smartphones, smartwatches, gaming consoles, and I think like that's a little bit of moving the goalposts of the AI narrative, because they're saying no, AI is doing well, but these other products aren't. But I feel like 2 years ago or even a year ago, there was all these ideas that AI was going to proliferate across computers and smartphones. So I guess that narrative is dead. That's my final thought there.
All right. Small cap of the week presented by Yellow Brick Investing. I will say, join yellowbrick.com/chitchat. Join Yellow Brick saved me on this one because I did not really know what this company did that well. Typed in the name, found like 5 or 6 super high quality write-ups, but the company is Kelly Partners Group. So actually came across this through a podcast with the CEO. So Kelly Partners Group is an Australian-based accounting firm roll-up. Does that sound sexy to you, Brett?
I don't know. Accounting firms, at least it's not consulting, right? Accounting
Yeah,
seems
I
something
guess.
that's going to have to be there forever.
They own, I believe, 40 different operating businesses now because they like acquired 2 new ones recently. They're primarily in Australia, but they've also added some in the US recently. They seem to be investing kind of heavily in the US, in US acquisition targets. Interestingly, if you go to their IR page, they have an quote unquote here owner's manual, which is it's a slide deck of what shareholders should expect from the company. It's actually super informative. And I really kind of wish that more companies did that. And I linked to it, Brett, if you want to open it up. It's kind of cool. But most of their operating businesses just provide accounting services to small, mid-sized businesses. So these are not huge offices, but they just help small businesses file their taxes and work on their accounting. And they typically do around $1 to $2 million in revenue each year. And here's a quote from their slide deck. It says, "We operate under our unique partner owner driver model where partners are owners of the businesses." So I went to Yellow Brick, typed in Kelly Partners, found a pretty high quality write up on it, and here's a snippet from that write up. It says KPG Holding creates a subsidiary. So KPG Kelly Partners, they create a subsidiary, and their subsidiary owns 51% of the acquired company. So they acquire 51% of it. And the partner who they're acquiring the company from will still own 49%. KPG Holding will not use any equity to acquire new companies, and they will always use debt where the debt is put into the operating business and the acquired company will repay the debt in 4 to 5 years. Also, they will split the payout, so the acquisition price, with a third of the acquisition price in year 1 and 2/3 after 2 years. So kind of nice from a cash flow perspective where you are recognizing the revenue up front, but you're not actually paying out the acquisition price until 2 years after. KPG promises the acquired business to almost double their income. They can promise this as the acquired companies are relatively small, with around $1 to $2 million in revenue on average. This means that sales, general, and administrative expenses are, as a percentage of the revenue, are quite high. You're thinking about these small businesses. Part of the biggest, I guess, hurdles of running a small business is all the SG&A expenses associated with it. KPG is centralizing those SG&A costs. I mean, this is kind of the typical blueprint with a roll-up in general, where you can offload those expenses to the parent company. And all of a sudden, if you are the leading accountant at that firm, your income just doubled. And so a lot of these like founders of these smaller accounting firms, they're not like they're technical people. They're accountants. They don't want to have to run the business. So if they can strip out some of those costs and just earn a much higher chunk on the net, sort of the net margin, they're more than happy to do so. So there ends up being a lot of acquisition candidates for them. This company is founder run. Brett Kelly founded the company, I think, in 2006, and he owns roughly 50% of the shares outstanding. He says they only use debt to make acquisitions, never shares. And then he also said in these interviews that they typically buy these accounting firms at roughly 18% EBITDA margins. Like when they buy them, that's kind of the profit margins they're generating. After they offload all those, or they centralize all those costs, they get them up to 35% EBITDA margins. So pretty attractive. He's also the CEO is a pretty interesting guy where he really aspires to be like the big serial acquirers. He says the people at the company really studied this big serial acquirers like Constellation, LVMH. He talked about Accenture and what was the other one? Arthur Andersen, and try to model themselves after those companies. The enterprise
Hopefully
value,
not Arthur Andersen.
well, the market,
not late Arthur Andersen.
yeah, I remember it was like a super tiny accounting company for a while, and then they ended up growing. So I think he was talking about the early days, but
hopefully, yeah. After 1990, we don't talk about
that. It's a $240 million market cap USD. Now, keep in mind they do have some debt, so the enterprise value is $311 million. Brett just showed the chart. Revenue has compounded at almost 20% for more than a decade now. Operating income has compounded at roughly 20% for a decade. EV to operating income stands at about 20 times right now. What do you think?
Interesting for sure. Yeah, I'd like to see. A lot of it is based on the CEO and trusting their culture, so I'd definitely have to look into that. So I can't make any judgments on whether I'd buy it or not, but the numbers make a lot of sense. I'd like to see the total addressable market. I know that's a hated word, but for these accounting firms. And yeah, we have a comment here that says, do you guys worry that KPG CEO has gone on a podcast and media spree? Perhaps. And maybe that should make it on your watch list or something. I know that some people talk about the jinx of going on a podcast and media spree for these CEOs, like with the Shopify guy, the Spotify guy. I don't know if that's statistically significant, but it can lead to perhaps some short-term momentum in the stock where people actually find out the name. But if the numbers make sense to you, it shouldn't matter.
No, yeah. And it's not like they're issuing new shares. So it's not like they're doing this to finance their own pocketbooks or anything like that. The 50%, owning 50% of the stock makes me a little more comfortable that he's not just trying to raise awareness so that he can sell his own shares. And he's pretty young, I think. Not like crazy young, but
40s?
he's might be late 40s.
That's the sweet spot. That's the sweet spot right there.
Yeah. Anyways, pretty fascinating. This is really big in microcap club. This company was. That's actually where, on the one hand, yes, I don't like when CEOs go on a bunch of podcasts and interviews and stuff like that, but I would not have heard of this company if he did not go on a podcast. So I was fortunate to hear that, and I'm not buying anything yet, but this might be one for maybe a deep dive later on.
Hey, your next stock research report, which you just had one released today, so maybe that's the one that comes up next. And I would say Buffett's in the media all the time. Probably not as much anymore because he's like 90-something years old. But if if that thing was 100% correlated, where going on media made it so your stock was going to start underperforming, Buffett or Berkshire Hathaway wouldn't work. Yeah, this one's interesting for sure. And if you look at it, 20 times earnings, essentially 20 times operating earnings. Historically, they've grown operating earnings at 18% a year. And it seems like, given their size, there's a long runway to continue that. If you believe that the company should trade at about 20 times earnings and you don't think there's too much risk of multiple compression, well, hey, that's 18% returns before any capital returns. Not bad.
Yeah, I like it. And it makes sense from sometimes with these roll-ups, it's like the big question is always, why would someone sell to you?
Yep.
If you're the acquirer? And if you're just an accountant, you're a really technical accountant, you can still get a very good payout and still get a good chunk of owner earnings, which will be substantially higher when you cut out SG&A. Makes a lot of sense. I imagine there would be a lot of motivated sellers if that was the case. And there's probably some good, like, I don't know, best practices that you can learn from some of the other accounting firms as well. So yeah, I find it fascinating. They've been going on a bit of a buying spree lately with
Hey,
US accounting firms.
all right.
And I think it's durable. Like the industry, it's huge.
And you still need that. Well, hey, maybe AI will destroy the whole thing. No, I don't know, but maybe they can use it to make the companies more efficient. We have a question here. Thoughts on the Wise Q2 trading update? There's another European company that I think does the quarterly update that isn't a full earnings report, but this is one that Ryan owns, one that you did a research report on, I believe a couple months ago, or maybe even more recent. Here's some of the numbers I'm seeing. Cross-border volume growing 20% year over year. Underlying income, which I think is kind of their normalized one without the interest income that's been skewing stuff, growing 17%. Take rate down to 0.59%, so it keeps moving in the right direction. And instant transfers, which is those that arrive instantly, up from 60% of volume in Q2 of last year to 63% of Q2 of this year. Other numbers they talked about: total active customers, 8.9 million. Let's see. 49% increase in card and other revenue. A lot of Wise account adoption. Underlying income, underlying gross profit remains elevated. This reflects the scaling of cost of goods sold relative to the volumes, while also continuing to invest and support and drive growth. Seems good. No complaints.
That cross-border take rate is the lowest they've ever had. They dropped the cross-border take rate to almost 0.6% roughly. So yeah, for one, as a customer, I love this because it's great if you can continue to lower what I have to pay you. And on the flip side, it incentivizes me. They have given me all the incentive in the world to keep my cash on the platform. My only concern here with Wise, you can't get a Wise card in the States. I don't know why that is, because I've been trying to. And they've been limiting account openings lately in certain markets. And I sometimes wonder if they're just like struggling with the demand that they get, or I just don't see why they would ever limit account openings in like broadly. I mean, obviously you don't want a TD Bank like situation where you're giving accounts to criminals, but they seem fairly secure, so I don't think that's the concern. I just wonder why they're limiting growth.
Yeah, good question. I read their conference call, I think, or maybe they didn't even have one. But yeah, that's something I would like to hear them ask. I think they may have answered that last quarter about the card in the US. So there's some regulatory reason that they're not ready yet. And that's for business only, because I know I had a personal one.
Well, you've got the card. I don't know how
do.
you got it.
Although I got to say, I don't use it much anymore.
I would use it pretty regularly. I mean, how often are you out of the States?
Sometimes,
Now.
but if you get it, the thing is they don't offer the point stuff, so like it's more of a backup plan to take out cash for free without those foreign transaction fees, and that can provide some value. But when you have the one thing I would say for the card specifically for Wise that could be a headwind is the huge growth in travel and airline cards that do stuff like, since they're international, they do say stuff like, oh, no foreign transaction fees, which you could probably investigate and see that Wise is giving you a better deal, but no one is looking at that. I'm typically someone that looks at that stuff and I usually forget and don't look at what they're actually charging. And then second, those airline and hotel points. So
yeah, no foreign transaction fees in air quotes.
I know exactly.
manipulate
I know.
the
I like
exchange
Wise.
rate.
Yeah, I know. I've read their stuff. I understand what they're doing, but I still use the credit card sometimes.
Yeah. Anyway, yeah, maybe that's a risk, but Wise card has still been growing like a weed. I think
Yeah.
there's probably a lot of customers out there that would use it, and I'm curious if is it really that much better to get your points, or is it better to get 4% whatever yield while you're holding it in a Wise account and paying nothing on foreign transactions?
Well, yeah. I mean, that's a whole can of worms, because if it's a credit card, then you're technically getting more time to pay it back on zero interest, and you can hold it into high yield savings. You can hold it in a Wise account, probably. Although I think in the US, they don't really offer that high yield thing, except if you're a business account, but I'm not exactly sure. Um,
See, this is why? Like, why can't they do that?
yeah, because
I would
I
imagine
haven't
the US
seen
is
them
a huge
advertise
market
that to
for them.
me. Yeah, it's true. It's true. They're moving slowly on that. And with that card stuff, it's a small part of their business. It's a nice thing to have. It's almost like a backup plan and something that definitely provides value. I would just say don't expect $100 billion in payment volume to be processed on these cards anytime soon. I think it's a nice feature to have to keep people as active customers, you know, that need this type of stuff to change to send money to different borders, cross borders.
You know what I continue to be more and more interested in is Remitly.
Hey, let's see what that stock's trading at. I own it, so I should probably know.
Oh, that's a good sign if you haven't checked.
It's
You
done
know
all
what I want to
right
talk
since
about before we end this? Jason Hirschman said something in that interview. We kind of talked about this on the end of the last episode, but Jason Hirschman said something in an interview recently that he did with Ian Kessel, and he's like, basically, he's like, if there's something on my watch list, I'm just not going to pay enough attention to act when the time comes. And I think it makes a lot more sense. I totally agree with that. Unless you are doing this for a living, you manage money for a living, and you're literally monitoring every position, including the ones on your watch list, and you're taking notes, keeping tabs on everything. I'm just not going to. I'm not going to read every call if it's on my watch list. I don't have the time. It makes way more sense for me to buy a couple shares, have some skin in the game, and then all of a sudden I feel more motivated to research it and be ready when the time is right. Whereas if it's just sitting on the watch list, it's probably going to stay there for a while.
Yeah, makes sense. Makes sense to me.
But I know you're kind of anti-starter positions.
Yeah, I think I'm pretty good at reading the conference calls on for stuff on my watch list. So maybe that's just me, but every investor is different.
But would you?
I wouldn't want starter positions to make more than 5% of my portfolio, though.
No. I agree. And you don't want too many, or else it's like you basically have a watch list in your portfolio. But do you feel like you know the businesses in your own portfolio better than the businesses on your watch list? Like if they all dropped 20%, would you
I,
feel more comfortable buying something that well, I guess you already own it, so you think it has more upside, but would you feel more comfortable buying it from your portfolio or your watch list? Or would it make no difference?
I don't think it makes too much of a difference. So I'm looking at my watch list right now on FinChat, which allows me to plug in that portfolio stuff, which is quite nice. So stuff on my watch list can range from things like Rocket Lab to Amazon to American Express to Sprouts Farmers Market, Airbnb, Adyen. I think most of those I would like. Almost all of those are on there just because I think the business is good or has some potential, and I would buy at a certain price, but the price might be 50% lower than it is right now. And I guess I didn't follow through with that with Adyen. Got a little nervous, but if it happened, I would hope that I would buy.
If you owned it, do you think you would have bought it?
Probably not, because trying to avoid doubling down on things. But no, I try to. I think the rule I try to have, and it's harder when you don't own it, is make sure you're in a position where you don't have to do much research at all if the stock drops and you're comfortable buying.
Yeah, that's fair.
But
All
you
right, I
can't
think
do it
we're
with.
bumping up on time.
Yeah, I would say you can't do it with 100 companies. I
No.
could probably do it. I could do it for like 20.
Yeah, I agree. And I will mention, we use FinChat literally all the time here. I work there and super biased, all the bias in the world. But I think it's a wonderful platform and it's really cheap if you're looking for a place to get all your data in one place.
And you can
I
try
think
it
it's a
for
wonderful
free.
stock research platform. FinChat.io/chitchat gets you 15% off if you're looking for a research terminal.
Yep. We've seen some people use it. Usually get at least a couple every week, which is beautiful. And that helps us out as well. So we appreciate everyone joining today. Thank you to our sponsors, Public, Yellow Brick, FinChat, and thank you for everyone joining on the live podcast recording. These go out on YouTube or live on YouTube 1:30 p.m. Eastern time every Wednesday, or probably 95% of Wednesdays, depending on our schedule. You can watch the replays on YouTube. You can listen to the full podcast on Spotify, Apple Podcasts, wherever you get your podcasts that come out Sunday morning. We don't care who listens. We just care that you do, or how you listen. We just care that you do and find some enjoyment from these podcasts. Well, let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, once again, and we'll see you next week. All right. Did I have the...